Hey everybody, welcome back to another beautiful day in real estate. Today we're going to go over mortgage rates, we're going to go over the bond, we're going to talk a little bit about the war, and then we're going to go over some statistics. And yeah, let's just jump right in. Interest rates, conventional sitting at 6.5 across the board. Average home purchase price is about 450,000 right now. So you're still paying, geez Louise, you're over $3,000 to get into a house. That's fucking crazy to me. Anyways, FHAs are right around under 6, VAs are right under 6 again on a national average. We're seeing the Treasury bond kind of retrace a little bit. But you guys, this is a story to tell right here. Last year, I worked with a buyer. I've said this one before. Worked with a buyer, wanted to build, decided to wait till interest rates came down. We were offering a $20K your way incentive last year, okay? And they decided to wait. They said, we want better interest rates. We'll wait till next year. So instead, they lost out on that promo. Interest rates fell to the 5.99s, but house prices went up to about $40,000 higher to build this house. That's just where I'm at. That's the cost that I'm at right now. That's the things I have to adjust for. And that's pretty minor considering some builders. I'm at 7%. Some builders are in the double digits right now. It's here locally. I'm not sure how other builders are. But long story short, they lost about $60,000 in equity this year because they decided to wait for interest rates. And the crazy thing is the interest rates are exactly where they were when they were looking to build. I mean, there is a cost to waiting to build. There's a cost to waiting to buy a home. And the more that realtors can start helping people see this, the better off we're going to be. I understand affordability is a hard one right now. I get it. But if you can get into a home right now, you are ahead of the curve, because there's a stat in here I'm going to show in just a second, and it's kind of mind-blowing. But so I'm going to jump back. Bond prices, you guys, so we kind of bounced off that 4.4 yesterday, moving into market open. I mean, it kind of came back up. We're touching this. I don't know if we're going to break through it or not. I mean, if we break through it, then we have a little bit of room to roam up to the 4.5s, and then we have 4.8, on support and resistance. But you'll notice that we've seen a decent amount of volume here. I mean, shoot, here. I mean, if that 4.4 is a pretty common area, we're going to see a lot of volume. Maybe not even support and resistance, just a lot of volume in general. Anyways, so if you're a trader, you're going to be looking at the trend lines, and the trend line states that we broke through this downward trend. We either could bounce off of that 4.18 range, 4.2, and then keep going, or this is just a fake out, and we're going to go back down into the 3.7s, the 3.6s, the 3.8s, etc., whatever, right? I guess all the way down to 4.41, we'd be still in good shape. The stochastic and stuff like that, you guys, it's a little different for this versus normal trading, but I mean, there's a lot of high volume in here that I think we need to see some sort of correction. That correction could go to 4.2. It could go below. We don't know just yet. I think the big deciding factor is going to be, what does the war in Iran look like? Now, there's been talks of the war's ending. There's been talks of they're going to have a ceasefire. Right now, everybody's eyes are on oil. And oil right now, it kind of took a little bit of a poop yesterday. Crude oil did, at least. We were at, let's see, this pulls up. So we saw our high of 115, and then we kind of saw two tops right here. So this was kind of an anomaly. You don't see this in oil. You just don't. I mean, you see that gap right there. That gap had to be retraced. That's just the rule of trading. When you see a gap like this, typically, I've never really seen it where it didn't, retrace. Anyway, so it tried to find a support here at 92, and it fell down. It crashed pretty hard. It crashed all the way down to $84 a barrel, and then this morning it's kind of rebounding. By the end of the day, we're going to really know, because if it closes like this hammer is going to show us that we saw a lot of buying pressure down here at 85 to 89, and we could move upwards again. If it doesn't, and that wick gets eaten up and we're down here closer to the 89, 88 range, we could see more potential downside. So when oil prices go down, interest rates follow, right? Because it's inflation concerns. When gas prices went up this last 2 weeks, and people are kind of freaking out, but this is just the way that a war starts, right? I mean, whether or not it continues is kind of up in the air right now, but this is what we have to be paying attention to. Bond prices need to come down, and interest rates will come down with it. Oil prices need to come down, interest rates will come down with it, because these are the two factors that drive the economy, right? So if investors are now, I was hearing this today, but investors are now finding it more appealing to get back into bonds than they are into real estate, because for so long there was an artificial low interest rate. Now, people think that 6% is a high interest rate. That is pretty freaking normal before COVID. I mean, yeah, we saw the high 4s, but dude, we're not going to be seeing those 3% anytime soon. We're not going to be seeing those high fours for a while, I think. But right now, it's more appealing to get into bond prices. It's more secure. It's more hands off. Your cap rates were sitting at 5 and 6% in some cases. Some were at 7 and 8. Like I've seen some properties off market, but if those are there, they're gone immediately, right? Like they don't hit the market longer than a day. But bond prices, if you're sitting at a rate of like 4.4% on your return for a 10-year bond, that's pretty solid because right now you have to remember we have to beat inflation, right? So investors are looking, how can we beat inflation? I look at real estate to beat inflation because I can build homes. So I can beat inflation by building homes and selling them for a profit, et cetera, et cetera. But an average investor that's looking to invest their money, they need to beat inflation. Inflation's at 2.7%. So if they're at 4%, they're beating inflation by 1.3%. So they're making 1.3% on their money. My generation, you under 30-year-olds think that that is terrible, but it's not. It's normal. It's normal. That is a secure investment. And even bonds aren't secure right now. Like I'm not going to say go buy bonds because we have a lot more to dive in on that side of things. But it's safer for an investor to buy bonds than it is to buy real estate when the cap rates are this low. Cap rates have to exceed by about 1% of what that interest rate is in order for them to make sense. Again, because now they have to make money. So if your cap rate's 7% and you're paying a 7% interest rate, you're not making money, right? You're not cash flowing. You could, if you pay cash, right, then you'll have cash flow. But if you're borrowing against the property, you're not making money. If it's a 7% interest rate, but it has to be an 8 to 8.5% cap rate for an investor to say, hey, this makes sense, because they have to beat the money they're borrowing, right? If you're making 7% on a 7% interest rate or less, you are losing money on that property in an investor's eyes. You might cash flow. No, you won't cash flow because it just wouldn't work. 7%, you're breaking even. Investors don't buy real estate for the headache and everything like that to break even. They buy to actually gain equity. They gain cash flow, right? You can gain equity, but it's safer for somebody in the mind of an investor to buy real estate, buy bonds, because bonds are going to be a guaranteed payout, or they're supposed to be, right? So investors are stepping away from the industry. I read an article. I don't remember if I pulled it up or not. Maybe I did. We'll jump into it in just a second. But this is the new norm again, you guys. Again, this is my warning. 7%, 30-year rates jump back 7% for the first time since August in some cases, okay? In some cases. Not everybody, but in some cases. You guys, this is what's, okay, again, anomaly. We're in war right now, so this is going to be crazy. But this is why I say waiting for the perfect rate does you no good. You might get lucky, but it's just hard for me to see where all of you are going to get lucky at once. As a home buyer, okay, let's shift from investor to home buyer. Your main residence that you get into, if you can afford to get into a residence right now, it's important that you do, because here's the next chart. First-time homebuyers reaches a median age of 40 years old. 40 years old for first-time homebuyers. The average buyer is 59, and the repeat buyers are 62. So I'm working with 22-year-olds right now that are looking to build, and they're making it work. You guys, if you can get into a home, you're beating a majority of the market right now. And a lot of us don't we take it for granted if we have the opportunity. Again, we're waiting for the perfect interest rate. But right now, you guys, what did Trump say? He said that he does not want to see home prices go down, housing go down. And they're not going to go down. I'm sorry, but the inventory doesn't outweigh. And I've seen the trend. Well, there's more sellers and buyers out there and blah, 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 for the highest it's been in history, right? But the thing is, there's still demand. I think my month of inventory, again, that's a national average, okay? So you have to factor in New York, you have to factor in California, you have to factor in Washington, Illinois. These are the states that have the most people moving out of them right now, okay? So focus on local, right? If we're focusing on local, my state, Bismarck, North Dakota, my city, it is a 1.8, I believe it. I want to say it was 1.2, but it was a 1.8 months of inventory. That means there's less than 2 months of inventory on the market. You need to see a gap way bigger than that. I'm talking 10 plus months of inventory in order for that to shape up and change. That's a big, big difference. See, that's why it's very dangerous to follow some of these charts, because the whole point of being in social media is to draw attention. And how do you draw attention? The easiest, creating a fear-based look. So all these people that are in economics, they have to make sure their pages are consistent. They're getting views, they're getting interaction. They're not going to post and be optimistic, because people want to see doom and gloom. I don't care who you are. You want to see it. So right now, I'm not saying the market crash. Off of that bit alone, affordability is hard. I get it. Okay. We're in a time right now where the market's rough, but that does change. It's normal. It's happened. I'm not saying that the affordability is normal, because it's not. It's reaching new differences, right? But they're focusing on how can they bring prices up in home prices. They're not going to work on crashing the market. They're going to focus on building more homes. They're going to focus on longer mortgages. They're going to focus on more incentives. They're going to focus on more government programs for people. They're not going to say, let's crash the market, because crashing the market doesn't do anything for the case of the presidency that's in the office. And you have to remember, the person who's in office for the next 2.5 years, he made his entire wealth off of real estate. He's not going to crash real estate, because in his mind, he has to make it make sense. I'm not saying he's for the people 100%, because no president is, but from the point of view, look at a 30,000 foot overview. Are they going to crash the markets before they get into the election year? No. They're going to figure out a way, and they're going to work on ways to make housing more affordable, and they're going to make it happen right before the midterm elections, because they got to win the seats. And if they fail, well, that it is what it is. But that's the focus that you have to pay attention to. What could happen? Okay? So this one right here is actually pretty nuts. Again, I work in new construction. For the first time in recent history, going all the way back to the 2000s, existing homes are more expensive than new construction homes. Why? Because we talked about this before, or last week. The builders built inventory, they raised prices, and now they have to eat it. I work with a builder that's not national brand, we're local, but we focus on quantity, not profit. So we focus on putting, so many homes at this much profit margin, rather than trying to exceed a profit margin so that we can sell 10 of them a year. We build production. In our market, that is needed, because people need affordable housing. So that's how we keep affordable housing down. We build to rents. We have 3-4 different developments we're working in. We're building anywhere from 26 to 40 inventory homes a year. Granted, my population is about 70,000. So we're doing about 40 inventory homes a year on top of the pre-solds, on top of build to rents. So we're over 100, right? And right now we're offering incentives out the wazoo. I'm sitting down with buyers, dude, and that 3-2-1 buy down is like a click in their mind, because they're worried about affording a home right now. But again, things could change in the next few years. 4 years, a lot can happen. I reference this 2022 versus now. That's 4 years ago. 4 years ago, I refinanced my house at 3.7. Didn't know real estate, but shit, it was still below 4%. People were in 2.5s, 2.6s, 3.1s. Like, people were below 3.5%. And now we're back to 7. A lot can happen in 4 years. So when you talk about a 3-2-1 buy down, those first 3 years, that first year is saving $500 a month, $400 a month. Second year is saving what, $250 to $275, and then you're saving like $150 the next year. You add all that up, you save like $6,000 to $7,000 in the first 3 years of building a house, and you're building equity, right? And you're in a brand new home that doesn't have any issues with it. You shouldn't, because some builders, I've seen the way you build homes, and holy shit, they're terrible. But that's what we're building, is we're building the American dream behind building a new home, because you have warranties, you have a stress-free home, you have lower homeowners insurance. By the way, it cuts in about half, just so you guys are aware. If you're looking to buy new construction, it cuts about in half, right? So if you're making $200 a month payments, you cut that in half, you're making a $100 payment monthly towards your homeowner's insurance. Now you have more buying power. Just so you know, that means you have about $12,000 more to buy a house if you're trying to max your budget. If not, you're saving money in your pocket. New construction is 2026. And right now there's a lot of talks about the Trump homes, how they're going to build 1 million homes. Builders are coming together with plans how to create more inventory. We need more homes. We need more affordability. But the housing market's not going to crash, because we're going to dive into foreclosures tomorrow. We're going to dive into inventory. We're going to dive into a few other things. But This right here also has something to do with the fact that homeowners still think we're in 2020. They still think we're in 2021. They still think that the interest rate's going to be this doesn't, it's just people think their house is worth more. And again, realtors, a lot of realtors don't really know how to explain to buyers or sellers because we want the listing. We're just running to get that listing that we're like, yeah, we'll list it for whatever you want. But then it sits for 6 months and you don't sell it. That was the big thing that I realized last year. We sold a fair amount of homes last year. I mean, we closed, I don't know, it was over 50, but people's homes sat on the market because they didn't want to work on or list it at a correct price. And here's another thing that we should be paying attention to. So I sat down, and I shouldn't say pay attention to, but here's the story. I sat down with a guy the other day, and he goes, like, usually a listing consult takes about an hour for me. I talk with you, I want to get to know you a little bit, walk through the house, talk about our comps, talk about our marketing, etc. And it lasted 13, 14 minutes. We came in, he powers me and my partner through the house. We sit down at the table. He goes, what deal are you going to give me? And I go, what are you talking about? He's like, well, I want to buy your new construction house, so you sell my house, and then I have to get this much, blah, blah, blah. Like, he was a deal dude to the nine. And he goes, basically what it came out to is he wanted me to cut my commission on the list side, and then he wanted me to cut my building on the other side. So basically we'd lose about 4% in total in the deal. And I go, no, I'm not going to do that. And he goes, well, you're not going to sell the house anyways. It's been sitting all winter. I'm like, yeah, that's, it's honestly pretty common. But here's what people don't like. People like that just think that they run the world and that you're just going to do it. But most realtors haven't been eating a lot lately. Like, they haven't been selling homes like they were 4 or 5 years ago. They're going to take that deal because they need money in their pocket. Whether that means cutting their commission, cutting their value, they don't care. They just need to be in a new listing. That's not me, man. I know the market we're in. I know what we have to be doing, and I know the value behind what I offer. So I'm not going to cut a commission because somebody thinks they deserve a deal. Anyhow, the next thing we'll talk on, again, it's just interest rates. Mortgage rates have spiked in the last 3 weeks, but it won't matter for the housing market. Mortgage rates have stopped being the driver of demand 3 or 4 years ago. Again, interest rates are not the deciding factor right now. Whether mortgage rates are 6.5% or 6% makes no categorical difference on demand right now. The limitation on the market today is prices. Until prices adjust, mortgage rates will largely prove inconsequential. So what he's talking about is we do need to see house prices go down. I'm sorry, I just don't see that happening. But again, I think we're going to see an incentivization behind buying homes. There's going to be something. Something's going to come out. Whether it's could be the checks coming from tariffs, it could be 50-year mortgages, it could be transferable mortgages, portable mortgages, it could be federal funding for down payment assistance. I don't know, but something's going to shift, and that's how we're going to see it. So interest rates, again, they're not the deciding factor right now. Other things have to be at play. So my whole point of this video today was to go over this and just kind of talk our way through this, right? We are seeing uncertainty. We're seeing prices go not really up. They're anticipating, I think the NAR said we're seeing probably a 1.6 to 1.7% increase this year. Possible, very possible. But what we should be paying attention to is if you have the ability to get into a home, do it. Okay? Because right now, the pros far outweigh the cons. And we're not going to see a housing market crash. We don't have the inventory for a housing market crash. We don't have affordability issues because the people that got into most of these homes got in at 2.5% and 3% interest rates. The only thing I could see that could potentially cause issues is the AI transfer of jobs, where they're cutting jobs like crazy because AI is more efficient, etc. But the point is, if you were able to afford a home, do it. Sit down with a lender. You guys, I think we're going to go back into more of a normal market. There's a lot of things going on around us, and the world is here to make us feel scared, right? That's what news is for. That's what all this data is for. That's why I need to break it down, and I want to break it down for you. So here's what you need to do. Follow me, and we'll keep going through this here together. If you have questions, if you have something I feel like I didn't talk about, comment below, and we'll just go dive into it as we progress. But I hope you have a great day. Thanks for watching, and we'll see you soon.